Welcome to the Daily Drawdown, where AI spending, rates, and risk get distilled fast. The market's trying to price two things at once: a massive AI buildout that still looks real, and a financing structure around it that looks a lot less clean. That's why semis can be down hard, while data center demand, power deals, fiber orders, and storage forecasts still point up. The biggest practical fact in this market is that hyperscalers have already spent about $800 billion on AI-related capex this year, and some analysts think that number can reach roughly $1.6 trillion next year. The top 5 hyperscalers also carry around $662 billion of data center commitments, so the demand signal for memory, compute, copper, power, and build-out equipment still has real backing behind it. What changed is the language management teams aren't talking like it's spend at all costs anymore. They're treating compute as a durable strategic asset, and they'd rather risk overbuilding than miss the AI cycle. That makes the semiconductor sell-off more striking. The group is off roughly 20 to 25% from summer highs, even while earnings growth in parts of the sector has been extremely strong and valuation multiples have compressed. Part of that is mechanical. Near-term bottlenecks in cleanroom completion and tool installation mean fabs can't absorb all the intended capex immediately. You can't just ship every incremental tool tomorrow if the physical build isn't ready. So the market is separating long-term demand from near-term deployment timing, and that's hitting semis, even though the spending backdrop hasn't actually broken. NVIDIA sits right in the middle of that tension. Its valuation has fallen to multi-year low P/E levels after a brutal drawdown, which is why some investors see the stock as the clearest way to buy the pullback. The counter-argument is less about whether NVIDIA matters and more about how the ecosystem is being financed. If customers are leaning on opaque structures, margin expectations and sentiment can stay under pressure even if unit demand remains strong. So for NVIDIA and the rest of the AI leaders, the next watch item isn't only demand, it's quality of demand and who is actually carrying the economic risk. That brings us to the highest signal development under the surface. Hyperscalers and asset managers are increasingly structuring compute access through long-dated leases, third-party equity, and debt that doesn't show up as plain vanilla balance sheet borrowing. The Meta BlackRock data center deal is the cleanest example. It's a $14 billion 1 gigawatt project with BlackRock taking an 80% equity stake and leading about $12.5 billion of financing, while Meta keeps roughly 20% and a smaller debt piece. The deeper point is that long-dated leases and residual value guarantees are being used to spread cash costs and liquidity risk across outside capital providers. That helps keep the build-out moving, but it also creates contingent liabilities and the possibility of circular financing. If end demand softens, that hidden leverage can reprice very quickly. Chinese competition is adding another layer of pressure. Names like CXMT are being framed as low-cost entrants that could pressure memory and GPU pricing if they scale aggressively enough. That matters because cheaper supply doesn't just hurt pricing power. It can also weaken the financing logic behind premium hardware economics. At the same time, reports of a Chinese producer making a small number of DUV lithography machines triggered selling that may have run ahead of the facts. DUV is not EUV, so the immediate threat to the most advanced node leaders is still limited. A second important shift is that companies are getting more disciplined about AI economics. They're routing tasks to cheaper models, using open source or older models where possible, and building orchestration layers that match workload to cost. That's relevant because lower cost per query doesn't necessarily mean less total infrastructure spending. It can support more usage and broader deployment while squeezing weaker providers in the middle. Expect more layered stacks too, lighter tasks on device, heavier work in private or centralized cloud, and more software that arbitrages model price versus performance in real time. If you want a reality check on whether data center demand is still there, look at the adjacent suppliers. Corning just reported a beat with AI data center sales nearly doubling and optical communications up 32%. Seagate also pointed to strong AI-driven hard drive demand, emphasizing that customers care more about capacity and availability than squeezing every last point of price. The caution is that AI adjacent doesn't mean uniformly safe. Guidance misses can still hit these stocks hard, especially when expectations are doing a lot of the work. And underneath all of it, build-out costs are rising. Turbines, wire, labor, and cleanroom construction are all getting more expensive, which is why utilities are signing long-dated power arrangements and tailored rate structures with hyperscalers. The private market side remains another fragile point. Secondary and private valuations for leading AI firms are still extraordinarily high, and some public market comparisons imply those marks would be much lower if repriced today. If public AI multiples stay under pressure, the risk is a cascade into private down rounds and tighter funding conditions across the ecosystem. Layer on security concerns, including reports of rogue AI agents compromising systems after model misuse, and you can see why Washington is getting more involved. In DC, the debate is moving toward testing, disclosure, and model oversight rather than any clean attempt to ban open-source AI, partly because policymakers know diffusion has already happened, and Chinese competition limits the room for hard restraints. At the same time, the Fed is adding macro uncertainty. Ahead of the meeting, market odds for a hike were split, but Chair Kevin Warsh's hawkish tone and reduced reliance on forward guidance have increased the sense that rate volatility could stay elevated. Real rate measures still look sticky, while bond and options flows have shown some positioning for lower yields or no hike. That has supported the case for fixed income as a hedge into the repricing. In equities, that backdrop is feeding rotation into defensives like staples and healthcare, into cybersecurity, and into selected small caps and travel or live entertainment names that benefit from AI spillover without carrying the same valuation or financing risk. Apple also keeps showing up as a safe haven trade inside tech, lower capex intensity, strong pricing power, and the ability to absorb turbulence while the rest of the AI complex re-rates. The market is not questioning whether AI demand exists, it's questioning timing, valuation, and how much hidden leverage is sitting inside the build-out. The next things to watch are clean room bottlenecks, financing structures behind new data center deals, any evidence of private valuation stress, and whether earnings momentum can keep offsetting multiple compression. If the spending stays real and the financing holds, this pullback looks like a repricing. If the financing starts to crack, the whole AI stack gets judged much more harshly. That's the brief for today from the Daily Drawdown. The signal is still in the plumbing, not the headlines. This episode was generated by Podkey. Create your own at podkey.fm.